Breaking news tonight. A single crypto whale has just moved $100 million in Bitcoin, and the entire market froze. The words echoed across financial networks like a thunderclap. In seconds, trading terminals from New York to Seoul lit up with red flashes. Order books flickered violently, green walls of support collapsing, sell orders cascading like dominoes. On Discord servers and Telegram chats, traders spammed emojis of fire and panic. Hashtags like BTC whale and crypto crash trended worldwide within minutes. The camera lens widened. Wall Street analysts sat back in their chairs, suddenly silent. Hedge fund managers refreshed their dashboards obsessively, eyes darting between charts. In Silicon Valley, venture capitalists whispered over phone calls, wondering if one transaction had just rewritten the future of digital assets. For smaller retail traders, those with 500, maybe 10 on the line, the scene was pure chaos. Screenshots of plunging balances circulated like horror stories. Some panicked and sold instantly, convinced the collapse had begun. Others clung desperately, muttering "HODL" under their breath like a mantra. Meanwhile, the media machine roared. CNBC anchors leaned forward with urgent tones. Is this the beginning of another 2022-style meltdown? Twitter flooded with speculation. Was it an exchange moving funds? A government unloading seized assets? Or the most feared theory, a mega whale preparing to dump everything on the open market? The drama wasn't just about numbers. It was about trust. In a market built on psychology as much as math, one move by a shadowy whale could trigger hysteria, reset fortunes, and expose how fragile the system really was. And then came the twist. Because this whale, this silent, faceless titan who had just rattled $1 trillion ecosystem, wasn't done. The $100 million move was only the first step. What came next would make Wall Street, Silicon Valley, and every crypto believer on the planet hold their breath at the same time. Cliffhanger. But what he did next made Wall Street and Silicon Valley hold their breath. The clock hadn't even struck midnight when the alert hit the order books. A sudden wall of red. A single transaction that made seasoned traders choke on their coffee. One wallet, one entity, had just offloaded 10 Bitcoin at an average price of $109,684 each. That's over $100 million in a single strike. The effect was immediate. Exchanges flickered under the weight of liquidation orders. Market depth thinned, and Telegram groups exploded with frantic messages. Whale dump! Brace! Prices wobbled, as if the ground itself had cracked beneath crypto's most unshakable pillar. Retail traders felt their hearts drop. Some scrambled for the exits, smashing sell buttons before the bottom gave out. Others leaned forward, eyes glued to charts, whispering to themselves, "Buy the dip, buy the dip." But the truth was, no one knew if this was the start of a full-on collapse or just a cruel head fake. It was the kind of move only a whale could make. Violent, deliberate, and impossible to ignore. And the markets, like a nervous crowd at a poker table, waited for the next card to turn. But the whale wasn't finished. Minutes later, a second ripple. Not a sell, but a bet. This same entity had just opened a 5x leveraged long position on 96,452 Ethereum. Nearly 100,000 ETH, multiplied by leverage, ballooned into a position worth $500 million or more. The community froze. The chat rooms that had been mocking the sell now erupted in disbelief. Wait, what? Analysts rushed to Twitter threads, trying to decode the move. On one side of the trade, he had just unloaded Bitcoin at the top of its range. On the other, he had placed the kind of leveraged Ethereum bet that could either crown him a legend or vaporize his fortune in a single price swing. It was like watching a general torch his own fortress, only to march his army across the river to fight on the opposite shore. Why Ethereum? Why now? Theories bloomed like wildfire. Some whispered about insider signals, whispers of ETH, ETF, approvals, or secret institutional flows. Others argued it was a trap. Dump Bitcoin to spook retail, then load ETH for the rebound, while everyone else panicked. But beneath all the speculation lay a harsher truth. Leverage is a merciless beast. At 5x, a 20% dip in ETH would mean total liquidation, tens of thousands of coins lost in a blink. The whale wasn't just betting on Ethereum's strength. He was betting against the entire market's ability to call his bluff. The scene had flipped from panic to obsession. Screenshots of the whale's position spread like wildfire. TikTok traders made breathless videos. YouTube analysts fired up emergency live streams. Memes flooded X. The whale as a kingpin rolling dice. The whale riding a rocket. The whale strapped to dynamite. But under the memes lurked a serious question, one that clawed at every investor's mind. Was this the move of a visionary who saw 5 steps ahead? Or was it the reckless gamble of a man drunk on his own power, staring down a market that was already buckling under its own weight? Either way, the gambit was live. The dice were rolling, and every trader on the planet was about to find out whether this was genius or suicide. Every great drama needs a villain. In the crypto markets, that role has always been played by the whales. Whales are not just rich investors. They are apex predators in digital waters, those who hold enough Bitcoin, Ethereum, or altcoins to sway the tides with a single movement. For retail traders, they are both mythical and terrifying. Invisible forces lurking in the depths, capable of dragging entire markets into the abyss. The archetype of the whale goes back to the earliest days of Bitcoin. Back then, when BTC was still measured in pennies, visionaries and opportunists mined or bought in bulk. Some did it out of belief in decentralization. Others, out of raw speculation. Fast forward a decade, and those who had accumulated thousands, even tens of thousands of coins, became titans in a world where most newcomers were scratching to own fractions. And with that imbalance came power. Time and time again, whales have proven their ability to manipulate sentiment with a flick of the wrist. A sudden sell wall on Binance, a coordinated withdrawal to cold storage, a liquidation cascade triggered by one wallet unloading millions. Each act sends shockwaves not just through the numbers on a screen but through the psychology of millions of traders. It isn't just wealth, it's theater. They believe they can move markets like chess pieces. With one night sacrifice a dump of Bitcoin, they can provoke panic, trigger cascading liquidations, and then scoop up assets at the bottom. With one bold rook advance a leveraged long, they can draw in FOMO buyers, riding the wave of retail euphoria until it crests. This arrogance isn't new. Look at the 2017 bull run, when a single sell-off from Mt. Gox trustee accounts repeatedly spooked investors, sending prices tumbling. Or the notorious bear whale incident, when one trader placed an enormous 30-0 BTC sell wall in 2014. Traders rallied to slay the whale, eating through the order like an epic boss battle. The lesson? Whales can shape narrative as much as they shape price. And yet, hubris has always followed them. For every empire built on whale tactics, history shows us the cracks. Quadriga CX's Gerald Cotton, once the king of Canadian crypto, died mysteriously, leaving thousands without access to funds. Du Quan, who strutted like a market demigod with Terra Luna, watched his empire collapse into ashes, trillions lost. Retail ruined. Even the mightiest whales can choke on their own greed, brought down by the very forces they thought they controlled. Because the market is not a static chessboard. It is an ocean, restless and unpredictable. And no matter how fat the whale, a storm can still wash it ashore. That's what makes this new gambit so dangerous. Here, we see the archetype fully embodied. A whale dumping 0 Bitcoin, shaking faith in the market, and then plunging headfirst into a 5x leveraged Ethereum, long as if daring the ocean itself to rise against him. It's arrogance in its purest form. Not just the belief that he can survive volatility, but that he can dictate its direction. Genius or suicidal gamble? The analysts asked. But beneath that question lurks another. What happens when hubris collides with history? Because history shows, every empire of greed eventually cracks. The bear whale got eaten. The Mt. Gox trustee drained credibility from Bitcoin's rally. Terra's implosion became one of the greatest cautionary tales in modern finance. Each time, retail traders paid the price, but each time, a lesson was carved into the ledger of crypto lore. And now, all eyes are on this whale, this living archetype of market manipulation. To some, he is a hero, a bold contrarian, willing to burn Bitcoin in order to light Ethereum's path to glory. To others, He is a villain straight out of financial folklore, gambling with sums so vast they distort reality for everyone else. But deep down, even whales know one truth. The bigger the gamble, the harder the fall. And when you build your fortune on arrogance, history doesn't ask if you'll fall. It asks when. The stage is set. The villain has made his move. The market holds its breath. And somewhere, beneath all the noise, the faint rumble of hubris cracking begins to echo. Every empire of greed creates its own opposition. And in the crypto arena, no whale swims unchallenged for long. When news broke that the whale had offloaded 10 Bitcoin and leveraged himself into a massive 452 ETH long, the immediate question wasn't just, what's next? It was, who will stand against him? Because for every self-proc